Do you know that right now directors across the UK are being disqualified for mistakes they could have avoided? Now, losing a directorship means you could lose your livelihood. Some people have lost their homes, and it's because they didn't know how to navigate UK insolvency properly. Now, here's some good news for you. Avoiding a disqualification as a director, it's not just possible, it's fairly straightforward if you take the right steps at the right time. So in this video, I'm going to break down some real life cases of why directors get disqualified, and I'm going to show you what went wrong, and I'm going to show you how you, a UK director watching this, can avoid those pitfalls. I'm going to tell you absolutely everything that you need to know to protect yourself. And by the end, if you're looking at insolvency, you're going to have a clear roadmap to stay compliant and safeguard your future. Now, listen, before we dive in, make sure that you hit the subscribe button, turn on notifications. I release videos every few days, and they're there to simplify insolvency and debt management for UK business owners, okay? Now, for everyone that doesn't know, my name's Chris Worden, and I'm from Director First. Let's start with the basics. Director disqualification is a legal process where a director is banned from running a company for a period of up to 15 years at the big end of things. Now, it's not just a slap on the wrist, it's a career-ending consequence that can impact your finances, reputation, and most importantly, your future opportunities. Now, why does it happen? It's all about your duties as a director. When your limited company faces insolvency, your responsibilities shift, and it shifts from prioritising shareholders to protecting creditors. Now, failing to do this can lead to claims of misconduct from an insolvency practitioner or from the insolvency service. Now, some of the key facts about director disqualifications, people ask me, who decides whether I'm going to get disqualified? Chris, can you guarantee me I won't get disqualified? Now, the insolvency service are the ones that investigates directors after a liquidation, and they can take cases to court, okay? So an insolvency practitioner is who you'll need to liquidate a business or put a business into administration. They will put a report into the insolvency service based on your conduct, and it's the insolvency service that takes action. Now, the duration of a disqualification, low end 2 years, top end 15 years, and it depends on the severity of the misconduct. Now, people go, well, what are the consequences? Being disqualified means you can't be involved in managing, promoting or forming a company without court permission, okay? Now I'm going to start to talk about the common reasons why a director gets disqualified in the UK. Now, these are, in my eyes, they're traps that you, as a limited company director who may be looking at insolvency, you need to avoid. Okay, if your company is in financial difficulties, you've got to pay attention. Now, the insolvency service investigates directors rigorously. They're looking for anything that's going to breach your fiduciary duties. And if they find it, you could be banned. The number one reason at the moment why people are being disqualified is around bounce back loans. If you've taken a bounce back loan when you shouldn't have taken one and you go into liquidation, it's highly likely the insolvency service is going to try and disqualify you. If you've increased your turnover to claim a bounce back loan, so let's say you was allowed to estimate your turnover only if you was incorporated after 2019. Anyone prior to 2019 had to take 25% of 2019's turnover, capped at 50 grand. If you only turned over 50 grand in 2019 and then you claimed 50 grand on the bounce back loan, You've took too much. You was only entitled 12.5 grand. And when you go into liquidation, the insolvency practitioner will report on that to the insolvency service, and it's highly likely the insolvency service will look to disqualify you. Another area where they'll disqualify you around bounce back loans is if you've used the bounce back loan personally. And there's a caveat here. I'm talking about the people who took a loan on the Monday and on the Tuesday they whipped it all out, or you took it out in big lumps. If you took the loan over a long period of time, monthly, in line with the year's previous drawings, it's highly unlikely you will be disqualified for that reason. Another reason why people get disqualified is wrongful trading. And this is one of the biggest causes of disqualification, and it happens when a director continues to run a business they know is insolvent. So remember, insolvency is you can't pay your debts when they fall due, liabilities are more than your assets, but more importantly, the business has no hope of recovery. But you keep trading and you incur more debts along the way. Now remember, when the company is insolvent, your duty as a director shifts. You're no longer going to work for the best interest of creditors. You've got to, best interest of shareholders. You've got to prioritise creditors. And what that means is you can't make the positions any worse. So if you continue trading without a viable plan to turn things around, it's seen as reckless. And this is something where the insolvency service can pursue you. Now, the triggers that you've got to look out for when it comes to wrongful trading, ignoring red flags like missing payments to HMRC, not being able to pay suppliers. I mean, if you can't pay staff wages, it is a clear sign of insolvency. And if you ignore these warnings, your risk of being accused of wrongful trading, it increases. Now, if you're taking on new debts, loans, or you're running up credit, knowing the company cannot repay, this is another big issue. I have directors regularly where they're calling me because they're insolvent. They need to, they really need to go for a process, and they go, Chris, I've been offered a loan off X person or X funding institution. Shall I take it? I had it the other day. A guy is clearly insolvent. He's had some really bad advice. There's no hope of this company being turned round. And he's took a bloody £50,000 RLS loan. And the person who sold him the loan, the broker, said, don't worry, if you fold down the line, you've got personal guarantee insurance. And I said, listen, if you liquidate down the line, you're going to be accused of misfeasance because you've took a loan when you're insolvent with no hope of recovery, and that personal guarantee insurance is not worth the paper it's written on. Because one of the terms and conditions of that loan will be you had to be solvent when you took out the insurance. Another thing that sort of trips people up around this is unrealistic optimism. We're taught to be positive, aren't we? But directors will fall into the trap of thinking like a miracle is on the way and it's going to save the company. And the problem is, and I see this, like I say, nobody wants to admit that a business needs to, most people don't want to admit that a business needs to go through an insolvency process. And they might have some funding coming through, or they might have a big job that's coming down the line. But we've got to deal in facts at this stage. Because if that financial miracle doesn't come and doesn't save the company, you have not got a good defence saying to the insolvency practitioner why you continue to trade for another 6 months, racking a load more debt. So again, I say this a lot, you've got to see things as they are and not worse than they are. I'll give you an example of wrongful trading. Worked with a retail director a while ago. He essentially ignored insolvency advice for over 6 months. He continued to place large stock orders on credit in the hope that sales would pick up. Now, I know this because he didn't use us in the end. He worked with somebody else. But when the company went into liquidation, creditors were owed an extra £200,000. Now, that was taken after the company was clearly insolvent, after he'd taken insolvency advice of multiple firms. Now, the director has been disqualified for 6 years, okay? So it's a big thing, you've got to be careful. Now, there's ways that you can avoid wrongful trading. And the first thing is act promptly. So as soon as you suspect insolvency, as soon as you're struggling to pay your bills at the end of the month, I'm not saying stop trading straight away, but what I am saying is seek advice from an insolvency professional, okay? Really, really important. There are people who call me, tell me what's going on, and actually say, listen, just keep trading and see things how things are going. Other people call me, I'm like, listen, you need to stop. This is going to get out of hand. And it sort of leads me on to my next point. When I say to people, keep trading, see how things go, I tell them to document their thinking, document their actions. So keep a detailed record of the decisions and the rationale behind them. And if you can sort of show on paper that you're acting in the creditor's best interest, it can protect you from disqualification and liability. For instance, I've got another client on at the moment. He is insolvent on a balance sheet basis, which means his liabilities are more than his assets. He's insolvent on a cash flow basis. He can't meet his bills at the moment. But in March, he has a big contract that pulls him right out of the hole. Now, it's not a done deal yet, but I've seen all the confirmation in the paperwork. It's highly likely. So what I've said is, listen, stop drawing dividends. You can't draw dividends out of the business. Speak to HMRC, speak to your creditors, let them know what's going on, and email yourself about this conversation. There's a reason why you're holding off at the moment, okay? And it's that documentation of your thoughts, getting them on an email. Should he go into liquidation and he gets asked the question, why did you continue to trade? He's got some evidence as to his thinking around that. Again, insolvency laws are complex. Professional guidance is going to help you navigate the process and hopefully avoid any mistakes. Another thing I want to talk about is failing to keep accurate records, okay? It might seem like a real minor issue, but if you fail to keep proper records, it's a serious breach under insolvency law. And when your company goes into liquidation, an insolvency practitioner is going to ask for books and records. And if you haven't got them, they're going to tell the insolvency service that you haven't got them. And now if records are incomplete, missing, inaccurate, they're going to assume the worst, that you're hiding something, okay? Now people say, well, what do you mean about keeping accurate records? It's like bank statements, invoices, payroll records, receipts, all this stuff needs to be up to date and accessible, Every sort of payment, loan, asset sale, it's got to be properly recorded. It's got to have clear explanations for sort of each transactions. Coupled with that, it's really helpful if you have board minutes. And a director said to me the other day, he says, what do you mean? Like, when things are going rough, it's important that you sort of sit down and you take minutes of how decisions are made. Now, it's good practice to do this all the time, but if the ship is sinking, if you are hurtling towards insolvency, it's more important than ever. Now, people get disqualified on the back of not keeping accurate records, okay? All the time. Because if you've not got accurate records, a liquidator can't verify things. They can't track how things were spent. And it leads to accusations of misfeasance. So please, please be careful. And it's quite easy to avoid record keeping issues. Get a bloody accounting software. Like, modern accounting softwares can simplify this process like you wouldn't believe. Xero, QuickBooks, Sage if you're a little bit better with those types of things. And once you've got it, use the bloody thing. Perhaps another idea is to get in a bookkeeper. If you're not confident with doing your Zero or your QuickBooks, get a professional in to ensure everything's in order. It might cost you a few £100 every month, but give it to somebody who does it for a job. It'll free up your time. And again, having accurate information on your finances helps you make better decisions. And listen, stay organised. Make it a habit to update these records regularly. Like, I think every single business owner, you should be reviewing your numbers, at least on a monthly basis. What's coming in? What's going out? What am I making? What am I saving for tax? And if I'm not making money, why am I not making money? If your business is losing money every month, you've got to understand the reason for it. Because it doesn't take a rocket scientist to work out if you keep losing money, you're not going to be in business. Another area where people get disqualified is preference payments. And a preference payment occurs when a director prioritises one creditor over others. So when the end is nigh, we see it where a director will repay a personal loan, or they will repay a family member, or they will pay a supplier that they've personally guaranteed before insolvency. Now, this is considered unfair to other creditors, and it can result in disqualification. Now, it can also lead to an insolvency practitioner trying to claw back the preference payment, although that doesn't happen very often, okay? Now, you've got to be super careful with these things, right? Okay, if you're thinking about paying back, like the company might owe you money, you might have a director's loan in credit, you cannot take that money back ahead of everybody else. You'll get absolutely castrated for that. You've got to be careful. Don't be tempted to make payments to creditors with personal connections. You know, rushing making payments before liquidation could cause you huge issues, okay? An example is a director repaid a £50,000 family loan 2 weeks before approaching a liquidator, and he basically left loads of other creditors unpaid. Now, the liquidator quite rightly flagged this as a preference payment, and what happened is there was a clawback made to his family member for the £50,000, and they got disqualified for 8 years. So can you imagine that? You're then bringing the trouble to your family member's door. So when it comes to sort of preference claims, you've got to treat all creditors equally. Avoid favouring any creditor, even if they're a family member or a close friend. And the key thing is obviously when you've become insolvent, you've got to consult an insolvency professional. You know, speak to somebody before you make any payments, because there are some exceptions to the rule, maybe key suppliers, and you've got to pay the key supplier to get the gear on site that will allow you to finish the job, which will result in money coming in, and it's for the benefit of creditors. But please, please, please be careful. Another area of disqualification is misfeasance. Now, the term misfeasance is a very broad term, and it covers any breach of a director's legal duty. So it can include undervaluing assets and transferring them. It can include using company funds for personal expenses, or it can include, you know, essentially it's not acting in the best interests of creditors during and before insolvency. So one example of misfeasance that I see a lot is undervaluing assets. It's called a transaction undervalue. And it's where you sell company property for below market value. So for example, you've got a van that's worth, I don't know, 25 grand, and you sell it to your new company for 5 grand. That is seen as misfeasance. Another issue that people face is when they use company funds for personal expenses. Now, you might pay for holidays, personal vehicles, and what that does is it creates an overdrawn director's loan account, and it's a sign of, you know, it's another reason for misfeasance. Another problem is failing to prioritise creditors. We taught this earlier. If you are taking on debt knowing that you're not going to be able to survive this, knowing that you're not going to be able to turn this around, this is going to be seen as misfeasance and it's going to cause you issues. Now, the way to deal with these problems that have just come up, on the transaction undervalue issue, if you're selling anything out of your business, especially if the business has become insolvent, use an independent valuation. Have your assets independently valued before you sell them during insolvency, okay? Really important. So you're not caught with an overdrawn loan account, you can't be accused of spending business money personally. Separate your personal and business expenses. Don't mix personal spending with company funds. It's a real red flag for insolvency practitioners. And obviously, when you become insolvent, your decisions are scrutinised. So try and act in the best interest of creditors. Listen, the top and bottom of it is, if any of this sounds familiar, do not wait for the insolvency service to be investigating you after you liquidate. Give us a call. Our number's 0800 086 2766, or you can book a free consultation using the link below. If you act early, you can save yourself from real costly mistakes and you can protect your future, okay? Really, really important. So, we've talked about the most common reasons people will get disqualified, but let's dive into some real life examples, things that I know about personally. And the story is going to show you exactly what can go wrong and, more importantly, what you can learn to avoid making the same mistake. Because across the UK, thousands of directors get investigated. Every insolvency is going to cause an investigation. Some of them end up being disqualified for years, while other directors, they take advice, they follow advice, they act responsibly, and they navigate through it, okay? I'm going to tell you one, okay? A construction director, and this guy was he was a managing director of a building company, okay? His business had been successful for 10 years, but he started to experience cash flow problems because a major client started delaying payments. Now, instead of seeking help, he continued trading, and he thought he had some big work in the pipeline, and he thought he'd end up getting paid. He essentially thought things would turn around, okay? He even took out short-term loans to pay for new projects. Now, these short-term loans were high interest rates, personally guaranteed, okay? But here is the catch. By the time he realised he couldn't pay the loans back, his company was insolvent, okay? He'd been trading for 12 months, taking on this extra debt from suppliers, from loan companies. He's another one who managed to get an RLS. So what went wrong? Well, he knew the company couldn't pay its debts on time, but he continued trading and he took on new debts. And what he should have done is paused. He should have took advice and basically made actions to mitigate the problems to creditors, okay? Now, this guy missed those opportunities. Now, the outcome is the Insolvency Service investigated his conduct and found clear evidence of wrongful trading. And he was disqualified from being a director for 8 years, and he was actually made personally liable for £30,000 of losses. Now, this could have been avoided with early action, okay? If you are struggling, act fast. Because if you're continuing to trade while insolvent, it's not just hurting creditors, it could cost you. It could cost you money, your reputation, financial stability. People could lose their homes over this. It's really, really important. Again, if you think you're insolvent, give us a call, speak to us. We'll walk you through what your options are. I'll give you another example. A lady called Susan, okay? Company went into liquidation. She was a retail business struggling with sales going down, costs going up. Now, when a liquidator reviewed the company accounts, they found like 100 grand had gone missing. No clear documentation. And when she's in liquidation, this lady, she just didn't comply with the liquidator. She'd You know, you look at what went wrong. No clear record of payments, no receipts, no loan agreements, and then didn't communicate with a liquidator. Once you liquidate, once you've appointed a liquidator, you've got to comply with what they ask. And that's why it's important when you're finding a liquidator, you find somebody that you can trust and communicate to. Because the top and bottom of it for this lady, she's been made personally liable for some of the missing funds. The liquidator's pursuing her to recover the 100 grand, and she's been disqualified for 4 years. Again, could this been avoided? Well, she might have still owed the 100 grand, but she could have, if she'd have complied with the liquidator, there's a better chance that she would have had a deal done and she wouldn't have been disqualified. If you just bury your head in the sand, that's when a liquidator is going to go, well, they've not given us any information, they've not complied. They're going to recommend that you get disqualified. Listen, it's really, really critical that you understand that not every insolvency goes well. Some of them are an absolute disaster, and many of them, it's because the director has not taken advice early enough, or they take advice and they don't follow the advice. So please, there are firms out there, we're one of them, we're there to try and help you, we're there to try and assist you, but you've got to tell us everything. You've got to go, Chris, this is where the bodies are buried. Like seriously, an insolvency practitioner is trained to find problems, okay? There's anything that you've done that you are wary of, or you wish you hadn't have done, or you're worried about, that's the thing you need to say, listen, I need to talk to you about this. How is this going to be handled in insolvency? And then at least everybody can see all the problems and we can give you some guidance on what the likely outcome will be. The key to this is advice early, okay? If you are facing financial difficulties, please get in touch with us. We're free, we're independent, we're impartial. We have got hundreds and hundreds and hundreds of happy clients who've even spoken about us on Trustpilot. Please, please, please don't suffer in silence. Now, we've looked at why directors get disqualified. We've looked at real life cases, and it's pretty clear how easily things can go wrong. Now let's talk about solutions, okay? You really don't have to be on the wrong end of an insolvency service investigation. It's about proactive steps. If you act responsibly, okay, you're not only going to avoid disqualification, but you can protect your reputation. It's bad enough, you know, putting a business into liquidation, but then having a lengthy insolvency service investigation afterwards that might end up with a disqualification or a, you know, losing personal money, it makes it a whole lot worse. Again, key things, act early. Don't wait things to collapse. The first and most important step is the minute you start to struggle paying people, give somebody like me a call. If you're missing payments to creditors, if you're on a time to pay arrangement with HMRC and you can't make the next one, pick the phone up. If cash flow is drying up and you're relying on loans to cover basic expenses, it is a serious, serious warning sign that you are insolvent. Now, the reason why it's important to act early is because the earlier you act, the more options you've got, okay? Early action will allow you to explore alternatives. It might be a CVA, and that's where you put all your debts in one pot and you pay them over a longer period of time. It could be like an administration and you buy your business out of administration and that saves the business. And acting early shows good faith. It sort of shows your creditors and shows the insolvency practitioner, hopefully they're more likely to view you favourably. It's going to limit your liability risks. So for me, if you're struggling with business debt, please, please reach out. Don't wait for things to get worse. Give us a call, book a free review. My name's Chris Worden. I'm from Director First. Thanks for watching.